We'll start things off. Hi, everybody. My name is Jackson Pino. I am the Public Affairs Manager at the Minneapolis Area Realtors, and I am going to show you the latest numbers from August in this month's September's residential market update. Quick agenda, what we're planning to do in the next 50 minutes or so. I'm going to bring you through the monthly housing charts for August, and then get into a little bit of market segmentation, talk about cash sales, something interesting that David and I found in recent weeks that wanted to, make sure that you all were aware about it, and we could have a discussion from that. From there, we'll have a conversation about affordability and payments, seems kind of natural flow there. And then we'll dive into a bit of a conversation around the wider economy before we have time for questions. Sound good? All right, let's start things off with the market update. As always, if you have questions, go ahead and put them in the chat. I will stop as necessary and bring them up. All right. August closed sales, a similar picture for what we've been seeing really ever since the full brake pedal has been pressed from the Federal Reserve, right? Closed sales down. For August, that's 11% down at just over 5,000 closings, which is down 11% from about 5,600 from 2022. And that in its own right is down about 19.5% from a decades-long high of almost 6,700, or sorry, 7,000 almost closed sales back in 2021 during the height of that run-on inflation period we were talking about, right? What does this all mean for you all? You know what that means. It doesn't feel as busy. It doesn't feel like that rush that we were all really enjoying in 2021, right? That's okay. We're reestablishing that new normal, and we will, see the light at the end of the tunnel. A little sneak peek for the rest of these slides here, right? But pending sales, those purchase agreements are not too dissimilar from what we're seeing in closed sales, right? 4,400 signed purchase agreements, down 10% from last year, which was just under 5,000 in 2022. The big hit that we were all seeing was from 2021 to 2022. We're starting to be a year removed from the worst of that that softening of market activity, of market demand, right? But the flip side of that same coin, because as we all know, sellers are buyers as well. People who are selling look at this sort of market and they see, oh, okay, there isn't as much demand, going to be less likely to sell, right? And because of that, new listings are down. Not down as much from year over year as we saw on the demand side of this. We're only 2% down at just over 6,100 listings on the market in August. But, this general trend that we've been talking about for a while, right? These people, the sellers in the equation, have a really good deal right now with their interest rates, right? If they purchased in the past couple of years, they have a deal of the century. If they were willing to refinance, why wouldn't you, right? They're sitting on an interest rate that they're not going to see right now in this market for obvious reasons. I think the pie chart that we showed last month was 96% of people who currently hold a mortgage, their interest rate is under the average that we're seeing right now for the nation. And that's a compelling reason to not list your house right now, right? The golden handcuffs, so to speak. Another reason why people have been a little bit reluctant to enter in this market, median sales price. For the past few months, in fact, for a few months, we were either flat or just barely negative, right? We were starting to really watch that quietly, wondering how far median sales price would dip down, right? Luckily, looks like we're seeing another consecutive month of two and a half, a little bit more than percentage increase of median sales price here in the Twin Cities at $380,000. You know, you're right if you're thinking it right now. It's not the 6% growth that we were seeing in 2016 through 2019. It's certainly not the double-digit growth that we were seeing from 2020 to 2021, but it is positive growth. Positive growth is reliable growth, sustainable growth. It's something that can be predicted. That's what we want, right? I think we all loved seeing price growth at 11%. Well, some of us, right? Especially those in this business, we liked it, right? This was unattainable for a lot of people, that 11% growth. We're responding to that, right? That run on inflation was very pervasive and very influential in our industry. As you can see here, this is year-over-year change in median sales price. It's the same thing, but instead of looking at the actual numbers of median sales price, we're just looking at that percent change, the gap between the bars of the last chart. And you can see we were up, you know, we were definitely 16, almost 17% increase from year over year in a particular month, about in the May of 2021, June of 2021, something like that. And we started having negative price growth and then just barely tipped into a softening of prices. And now we're back into the positives. You see that 2.7% that we just reported, and a little unofficial hint for you. Looks like we're still barely positive for this midpoint in September. That's a good sign, right? So, what is another realistic sign that we all need to see from this, right? August percent of original list price. This is a great indicator for us of another way of showing demand, right? Clear, strong demand in 2021, and we have re-regulated. The market has readjusted, and we're now at asking price, 100% marginally up, you know, relatively flat from last year, which is a good indicator for us, right? We're not below. We haven't dropped in terms of percent of original list price. There seems to be an accurate reflection for the most part along these median lines that people are listing at about what they expect, and then they are getting what they're listing in terms of sales price, right? Cumulative days on market is another great indicator for us, and this is more for establishing that shelf life, if you will. How long is it going to take to sell my house, right? And we have seen a quick shelf life, a pretty busy market in terms of how many days does it take to sell. You know, for a number of years, 2020 onward, it's been about 2 weeks or fewer for half the homes. You know, median, half the homes sold less than that 14, half the homes sold more. And that is still it's a pretty quick pace. Yes, it's down 1 day from 2022, and it's not quite the 10 days that we were seeing at the height of this frenzy of 2021, but that's still a fast market. So if anyone's saying it's a slow market, yes, slow relative to 2013, 2014. As we'll see in one of our next slides, something would be considered, you know, more of a balanced market in terms of our absorption rate, right? Looks like that was a slower market, definitely during the Great Recession, a slower market, right? But we are staying relatively stable here, right? August inventory. What did it look like in the last day of August? Those homes that remained on the market, we were at about 8,300, which is just about 10% down than what we were seeing last year. And this is something to keep in mind here, right? Yes, demand is down, right? Inventory is not up. You know, you would think if there aren't people buying homes on the market, then these homes are languishing on the market. It doesn't look like that's the case. If you know, you flip back between the speed at which homes are leaving the market, getting those signed purchase agreements, getting those closings. And then the homes that are left on the marketplace are, down with, the same scale of what we were seeing in 2021. Our market inventory is still tight. There are good things and there are bad things about that, but the reality is the market is still tight. And it doesn't seem to be growing. Did for a little bit at some point in the year, but really the general trend is that we're still in a tight inventory shortage in many ways. Now with inventory staying, let's say, relatively the same, right? And demand going down, that means our month supply of inventory is going up. It's going up because there are fewer people willing to buy. We're at 2.2 month supply of inventory. That is 18.5% up from last year's just short of 2 month supply of inventory, which is again 25% up from that. Again, I'm going to use the phrase frenzy of 2021. We got to start conditioning ourselves to remember 2021 was an outlier year, right? We don't need to see 2023 or 2024 as problems, or as cause for concern because we're not 2021. Let's start conditioning ourselves to use that appropriate terminology. So I'm going to keep using that phrase, frenzy, for this. And that's, a reflection of that demand softening that we are seeing month after month. So, a word of contextualization here for you. 2 month supply of inventory is still a strong seller's market. Remember when I was saying what a more balanced market looks like? 4.5% to 5%. That's much more of a balanced market from academic research. 2 month supply of inventory, you're still in a strong seller's market. There's still reason, to tell your clients who are selling that they have leverage in the marketplace if they choose to list now. Any questions on our charts, our monthly charts? I know y'all love the monthly charts. Put anything in the chat right now in the next 10 seconds or so if you do have questions, you need clarification on anything. If not, we're going to start doing a little bit of that exploration, the market segmentation that I really love to dive into in my webinars. I don't see anything quite yet. If we do, I do have a nice little quote. If y'all think that you weren't going to get a quote from either me or David in this, I just delayed it for you. I want to make sure that we catch your attention again when we're moving on to our keynote of the presentation. And what better way to do that than to bring up the late, great Zora Neale Hurston. She was an American writer and anthropologist during the civil rights movement, and she has a couple amazing quotes, very powerful. One in which that I love, being a research and a stats nerd that I am, is that research is formalized curiosity. It is poking and prying with a purpose. And I encourage you all, if you are regular followers of this webinar, embrace that mentality. Formalize your curiosity. Don't just stop there with, that'd be interesting. Poke, pry, try to get to the bottom of things. Do it in a way that is centered on curiosity and better understanding, not necessarily trying to prove your point, right? But do it with purpose. And you'll be able to learn a lot of great things about the market. That's that extra level of curiosity that I encourage you all to do when you are jumping into understanding the housing market better. And in that spirit, let's look into cash sales, right? So obviously, some people are capable of and regularly do purchase their next or new home with cash. This is what it's looked like, just giving you a little bit of historical context for the Twin Cities MSA. In each previous month of August, you can see we had a boom in 2011 through 2013, the recovery out of the pandemic. Out of the Great Recession, and then a leveling off of sorts through that economic return. And then from 2021, 2022, and 2023, there's a bit of a leveling up, higher number of about 900 to 930 cash sales in the Twin Cities. Now, all of this is great. And if you're really into cash sales, this might be something for you. But I think a lot of other people say, well, what does this mean in context, Jackson? And that's why I bring you the next slide, right? The share of home financing types by year. It's a little busier, which is why I wanted to give you that green slide first. This is if you take every sale that happened in a given year, and then you break it down by the financing types, cash, conventional, FHA, or other. This is what that looks like. You can kind of see that conventional is, unsurprisingly, the largest share, right? I want you to understand that when we're talking about cash sales. Obviously, it's not going to be the big thing. It's not the huge determining factor here. Conventional is, but it's context setting for you all, right? And now that we're understanding we're talking about a smaller slice of the market, let's take away the conventional and the FHA and the other and just look at cash deals as a percentage of all sales, right? And you can see something fairly interesting here. There are two high points, so to speak. One, that percentage of cash sales that we saw in the green chart, that there is a height from 2011, right? Dwindling down to 2013, and then a leveling off, and then a different type of increase from 2021 onwards. If you remember in that green slide, it was flat and higher, right? It looked like a little mesa, right? This is an increase. And what this is showing you is that cash sales, while all being roughly at the same price from an absolute number standpoint, around 900 sales per year, right? As the market has softened in demand over time, cash sales, or more appropriately, the percentage of cash sales that have been proportionally made up of all sales has grown, right? It was 12.5%, then 15% last year, and now it's 16.5%. That's a growing portion, of market share, while it's still the same number of homes, roughly, right? That's an interesting thing. That's showing you that cash deals are comprising more and more frequently a larger share of the market. Something to be paying attention to, particularly when you divide things out by property type. You got single family. It's the same thing here, cash sales as percentage of all sales, right? But now it's divided up by single family, townhome, and condominiums, right? There was a height in the Great Recession of almost 15% of all sales were cash sales in single family homes. We're not at that point, right? But there has been an increase, not only in single family homes, which I think would be a little bit more interesting, a more, I guess, more obvious, right? But also in townhomes and condos as well. In fact, with townhomes, we are at our historically recorded average at 4.5 or 4.6% of market share. That's really interesting, particularly if you're in the business of buying and selling, non-single family homes, those townhomes or condos. That's something that you may want to be aware of, right? Another thing that may be part of this is a conversation that's been emerging in the past couple of years is the idea of investor ownership of residential properties, right? There could be part to be played here with the idea that not only single family homes, that bump that you're seeing there in that dark blue, but also townhomes and condos as well, right? That's the rental industry potentially playing a part, some part, in what you're seeing in this chart. Another thing that I think is it was quite shocking for both David and I when we were looking at this was cash deals as a percentage of all sales, same thing, but now we're just looking at the luxury market, million plus, right? Normally, it looks like we're seeing that the million plus performs a little bit differently than what we've been seeing in all those other charts. There is no big bump in 2011, 2012, 2013, right? And there is that flatness, but look at the far right column right there. 34% of deals in the million plus as a percentage of all sales were with cash. That's something that we're going to be paying attention to. We want to make sure that for those of you who are in this game, we want to make sure that you're aware of it and paying attention to it. We find it fascinating that all of a sudden there was a huge boost like this. So happy to keep looking into this. I apologize, Christine. I have horrible eyesight even with these glasses, so I'm gonna have to lean over here and read this. Volume during the recession, lenders were not lending on condos. Yes, yeah, that is probably the case. You're talking about what, this last slide here, Christine. That would make sense. Let's jump into affordability while we have some time left. We're at about half time. Affordability, another market segmentation that everyone is keenly aware of. Oh, Christine, you're talking about volume is pertaining to all cash sales volume. We aren't looking at dollar volume. We're looking at a percentage of unit sales, but that could be something that we are willing to look into. That's a great suggestion. I appreciate that. I don't have charts made out on this on cash sales in terms of dollar volume, but we'll explore that. Affordability. This is probably one of the more, we always have silver linings of dark clouds, but there are dark spots within those dark clouds. This is one that I do want to make sure people are more prepared to have a conversation about with your clients, and understand this because it may not be the most intuitive. This comes out in our monthly reports every year. It's usually in the middle of a PDF that I hope people are diving into and taking the time to fully understand it. But this is an index. The number itself it measures affordability as a percentage of the income necessary to qualify for a median price home, i.e., if it was 100, that means that the median household income is exactly 100% of what is necessary to qualify for the median price home under the prevailing interest rates. Interest rates have a big portion to do with this. What is concerning here is that you can see with this line chart here at the bottom, we're at a low point that we've been at ever since 2004. The more affordable homes are, the higher this line gets. It looks like we were at a peak at about 2012. We've been trending up and down, but generally down since 2021. And this number is just about at 100. If it goes below 100, that means we have to start having a conversation that the median household income by this measure doesn't necessarily qualify for the median priced home under those prevailing market conditions, right? We've never been this low before, but it's something we are more cognizant of. Put simply, homes are becoming less and less affordable. And this is a way of showing that. Something that we all need to be able to communicate to our clients, particularly if they're that marginal client, maybe that first-time home buyer, right? Another way of measuring, another way of measuring this is monthly payments. And I do see some chats here. Let me lean over and see if I can see these. In a vacuum, what an affordability index of 100 states is that the market is not able to pay a higher price II being a combo of property value and interest rate. So we're looking at what will glass ceiling. Yes, Steve. It's I mean, put simply, if we're looking at this affordability measure here, let's go back to it. Um, the buyer would want this line to be as high as possible. They would want their income to be more than 100%, in some cases, magnitudes more than 100% of what is needed to qualify for that median priced home, right? Best bang for their buck. That's higher the line, the higher the value, the higher the affordability, right? And then Christine, you add in a misnomer of recession affordability is that a first-time buyer could not purchase many of the homes because of the condition, and they were investor sales. Take take the most recent 2 years, right? I will say yes, sometimes, generally, uh, but it's not always the case, right? Because we had amazing interest rates 2 years ago. There are a lot of people who are first-time home buyers who jumped in. There are a lot of people who are really afraid and didn't, right? So I would say you have a point. You have a point to be made there, but there are opportunities, and a lot of it, like we're talking about, depend on interest rates. Um, let's jump into the monthly payments because I do want to be sensitive of everyone's time here. Monthly payments are on the rise. We used to show this, and here we'll pull out my handy dandy little laser pointer here. We used to show this as a great way of saying like, wow, look at the deal we were getting, through 2021. Home prices are increasing, but monthly payments aren't, right? We've recorrected, right? And now monthly payments are on the rise. We are now, for a median family income, seeking to own a median priced home in the Twin Cities under our current market conditions. We're looking at 2,800 little and change for a monthly principal, interest, taxes, and insurance payment. Uh, that is $1,000 difference than what we were seeing about 2 years ago, right? And people are feeling that. The phrase, this is a monthly payments business, is nothing more apparent than what we're seeing right there. And I think what is just as interesting and kind of speaks volumes of not just the absolute numbers increase, but the rate at which this increased is this next chart here, where in black, it's the year-over-year change in those monthly payments. And generally, we see that there's an increase in monthly payments, right? There are few occasions, right, during recessions or times of unsure market activity where we see declines. And in fact, we were seeing it coming into 2020 and then a little bit throughout 2020. But then year-over-year change picked up because home prices increased, right? And then leveled out a little bit. But then with the Federal Reserve increasing interest rates, all of a sudden skyrocketing. 47%, just short of. Year-over-year change in monthly payments for a particular month in 2022. That is what people are feeling right there. Luckily, we're starting to cool down a little bit. Yes, we're at 20% increase year-over-year in monthly payments right now. But I would be surprised if all of a sudden we're back up to these levels. And I know David and I like to beat this horse dead sometimes, but this great mean reversion chart, which I think most of you should be familiar with, it's a staple of our webinars, shows that because we are below this gray year-over-year appreciation curve of what to expect home prices to grow by, that lower bound, we were really getting a deal that blue line showing average sales prices was was noticeably under that lower bound for a number of years because of economic rebounding from the Great Recession. And this most recent recession, we're seen here in this gray pillar, brought us back up to within those bounds. We still, jury's out with 2023, whether or not we will go all the way up to the lower bound again, but it's not, we need to understand that just because prices change, demands change, it's got to be relative to something. Make sure that it's relative to, historical averages, right? Let's take a minute here and jump into the wider economy. Zoom out for a second. For those of you who really have your thumb on the pulse of, NAR's reporting for research and housing statistics, you'll see that the NAR August housing report was released this morning. There are two big takeaways that I want to make sure that people are aware of from that, just so that way we can get a context of where does the Midwest sit nationally, right? Region on the left, sales on the right in this instance. Across the nation, each region is down a noticeable amount, right? The Northeast is down the most in existing home sales. The South is down the least at about 12.5%. Midwest, not too good, not too bad. We're still negative, but we're not the Northeast. NAR's report also showed home prices. I'm taking away the absolute numbers on the home prices. Those aren't fair to compare to, right? But the percentage changes are a little bit more fair. And you can see where the West only grew by 1%, the South 3.2%, Northeast by 5.8%, the Midwest leading the regions at 6.8%. And so for that, gold star for us. All right, what did Chief Economist Lawrence Yun say as a main takeaway I want you all to be aware of? Home sales nationwide have been stable for several months. I think David and I would relatively agree with him for the most part. They have been neither rising nor falling in meaningful ways. Mortgage rate changes will have a big impact over the short term, while job gains will have a steady positive impact over the long run. I think Lawrence Yun has a point here. I think this will generally be the trend. None of us have a crystal ball. We want to be aware, prepare for the worst and hope for the best, right? What we are seeing, right, in also recent news, Federal Reserve is holding their interest rates steady, but they are hinting that there may be one more rate hike this year to ensure that inflation is under control, right? This is Fred's 30-year fixed rate mortgage average, which is highly dependent on those Federal Reserve rates. And you can see that, yes, we are above 7%, which is the historic average. We aren't spiking up, neither is the Federal Reserve's interest rate. And yes, this does look high, right? But we need to remember that it is the historic average. And we have faced much worse times. A word of caution, if you're some people, we really love to trust in Lawrence Yun, and I think you should for the most part. But let's keep in mind that there isn't a guarantee that job growth is always going to lead to a better economy. I would be remiss if I didn't add in the fact that one of the largest labor unions in the country, United Auto Workers, has decided to strike against the big three domestic car manufacturers this week. And that standoff, while localized and not anticipated to have a larger impact on the economy, can potentially go on long enough that it would first impact sales of cars, as in not sticker price sales, right? And then the actual supply of of vehicles, which then impacts GDP, which then in turn might impact uh, the Federal Reserve's interest rate in their decisions. So a lot of conditionals there, a lot of ifs, but I want you all to be aware of that stuff. If this is news to you, look into it. It is important to at least just be aware of it. 20 minutes left. Let's talk about, we're saying be adaptable, be flexible, things are changing. Yes, but in the most part, we knew this was going to happen, whether it be David and I observing what was happening, or Lawrence Yoon and his team. We've known that this was going to be the case, the general trend of there will be a couple down years, there will be a resurgence. Look at this. This is a dated chart. If you've been following me and David for a couple of years, you've seen this chart well before. This was back in the end of 2021. Even back then, they were estimating down years in 2023, particularly in unit sales and home price and dollar volume, and then a recovery in 2024. We're still seeing that. The numbers might be a little different, right? But the directionality is not. And if we look at our own local data here, you can see we know fairly confidently that sales in red here, this trend line, leads and kind of helps predict change in sales price, right? And so, yes, we're down a little bit in sales. We may not be fully out of the woods yet, but sales are rebounding. They're down, but they've already seen that rebounding begin, right? We could be seeing that light at the end of the tunnel. Estimated home price and performance, yes, down about 1.5%. This year, that's where we're at right now. We're anticipating growth coming out of it. And ideally, in the long term, we'll see that 4-5% growth that we were seeing in some of those very early charts that I was showing you. So, there is reason to, weather these market conditions right now and get people excited about buying homes. It doesn't have to be doom and gloom. And I know what some of you are saying. Jackson, you just said get people excited about buying homes in this economy? Yeah, I get you. We've had a lot of conversations about how this is kind of dark, right? But we need to remember the context that we're in, right? Silver lining in a lot of this. Average FICO score by state, we're leading the nation, Minnesota is, in average FICO scoring at an average of above 740. That means we have people who are financially capable and ready to buy. We just got to convince them that it's okay. That just because we're not in 2021, it doesn't mean that you should turn down an opportunity of a lifetime in many ways. And we'll get into that in a minute. But to further prove my point here, latest on the Case-Shiller Home Price Index, yes, in pink, that's us here. We're down, so's everybody. Everybody's down, right? But some highlights that I wanted to draw your attention to here. Chicago, one of the bigger metropolitan areas in our region, yes, they're down, not as much as us, granted, but they're also down. And then some of the more extremes, San Francisco, we're negative home price index and have been for a while. Look at that fall, Denver, the same way, a more comparable city to us, below that threshold of positive to negative in this home price index. We've bounced off it, and luckily that means that we are not having the negative impacts of seeing a rocket ship frenzy like some of the coastal cities were in 2021 and 2022. We saw our hype, we're reacting to it, and ideally now we're bouncing back. So the question is now still a good time to buy? Let's think about this, right? Inventory is low, even with the decline in demand from higher interest rates, that prices will likely continue to rise further, but if only at a slower pace, right? And I'll admit rates are at their long-term average, that's 7%, right? And they're as high as they've been in years. The good news is that buyers can always refinance their loan when interest rates fall, right? Time is more important. You want to get in sooner to start building that equity, right? Home values tend to keep pace with inflation and then some. So owning a hard physical asset like a house is better, right? You don't want to just hold on to that money and have your savings erode due to inflation. And it's like a partial retirement plan that you can live in. I know you all know this stuff. I'm framing it for you uh, to in the context of all that we've talked about here to give you that convincing argument to tell people it's okay. It is time to buy. Now, if someone's adamant, will waiting pay off, right? Probably won't make sense because today that standoff continues between buyers balking at high prices and sellers clinging to their homes and their interest rates, right? When prices or rates do fall, you'll have more competitive bidding. And those who wait will be swapping their affordability problem for a competition problem. Inventory is not really rising like we saw, only month supply of inventory due to lower demand. And so if rates fall, that $400,000 home could be back up to a $430,000 home. And that's before the bidding war begins. So this may boil down to just a matter of paying more in interest versus paying more in principal. And when your clients wait, the most important thing that's being wasted is time for them to invest early in real estate that will grow that lifelong wealth, that intergenerational wealth, that security that many people are looking for. And so if they can encourage them to do so. And I think most importantly, we need to educate them on what are the actual dollar points, make sure people are aware of down payment assistance, different types of financing options, and the actual thresholds needed in order to get a home that fits them, right? You all know this, but it's a refresher for you. We got 10 minutes left, so I'm gonna stop there and ask if anybody has any questions for me, either in the chat. I can't actually see the UI for this at all. I want to make sure, David, if you're still on here, you're more than welcome to jump in with any questions or comments you have, but if not, happy to take questions from the group. All right, I don't see it. Oh, yes. Slideshow. Yes, you will all get a copy of this YouTube link. You will get copies of these slides and a reminder to sign up for the next webinar in October in the next day or two, depending on how quickly we get this uploaded to YouTube. And if there aren't any further questions for me, I will say goodbye. Thank you all for spending the last 50 minutes with me, and I will see you all the third Thursday in October for our next webinar. Take care, everybody.